the ultimate guide to investing in cryptocurrency. How to make money on blockchain, DeFi, Bitcoin, altcoins, NFTs, and the next big thing, the Metaverse. Written by Christie Brothers, narrated by Russell Newton. You wake up one day, and it seems like everyone is discussing Bitcoin, NFTs, and something called the Metaverse, and you wonder, what did I just miss out on? Is this all hype, or is there really something to all this talk about cryptocurrency? Don't fret, you aren't the only one. Countless people have underestimated the potential of Bitcoin and cryptocurrencies. Perhaps the most famous case of this was in Florida in 2010, when a programmer purchased 2 pizzas with 10,000 Bitcoin, which in 2022 would be worth around $40 million. Now, to fully appreciate this brave new world of financial technology and its intersection with both the digital and physical realms, we must travel back in time and trace the timeline of the currency. 1. Blockchain Internet, Web 1, Web 2, Web 3. 2. Cryptocurrency. 3. NFT. 4. DeFi. 5. Metaverse. The World Wide Web. Everything began with the ARPANET project in 1971, a computer network spread throughout the United States to share data during the Cold War, mostly for military purposes. That little experiment grew over the next 10 years into the international network known as the Internet, which is utilized by both the public and commercial sectors. That's exactly what it is. Hundreds of underwater cables linking all the world's computers. The World Wide Web is a collection of materials that can be accessed over the Internet. It was founded at CERN in 1990. Web 1.0 was the first version of the Internet, and it was read-only. It was made up of static HTML pages, and people got the information passively, without any type of interaction. Then came the period of social networks, which introduced the so-called Web 2.0, enabling users to communicate and cooperate with one another through social media. 6 Degrees, 1998, is regarded as the first social media site. However, there was little activity, owing to a shortage of individuals linked to the web due to network limitations. The second era of the Internet officially started in 2005 with the launch of the first global social networks such as LinkedIn, MySpace, and Facebook. The sign-up and log-in era began, and users could produce information by generating content in a virtual world, and gathered data increased quickly owing to online and mobile applications. All of that information, however, is held by tech corporations who transform data into revenue by selling to marketers without sharing profits with consumers. This is why Web 2.0 is described as centralized, an internet ruled by businesses that offer services in return for your personal information, in which we have relinquished our privacy in exchange for nice applications. The photo you uploaded on Instagram a few minutes ago is not controlled by you, but by the corporation that runs the network. We own nothing. To be more specific, the only digital object that can be purchased, registered, and therefore held on Web 2.0 is a name, i.e., www.example.com. The introduction of blockchain technology transformed the game, ushering the Internet into its third stage, Web 3.0, a decentralized domain owned by nobody who can monetize your personal information, but you can. Platform profits are dispersed to users as an incentive to participate to decentralized governance. For example, an app may pay you for certain private details, so the profit is split between you and a third party showing ads on the web page. Imagine a data marketplace like OpenSea, a social network that compensates you for being a frequent user like Steemit, video sites that compensate you for your time spent viewing like DTube, a browser that prioritizes your privacy in exchange for money like Brave, an online file system that compensates you for the storage of files on it like IPFS, play-to-earn video games, often known as GameFi, This is where we are today, at the start of a new age wherein you're the only master of your data and time, which you may monetize. The primary characters in the next scene will be our beloved decentralized programs, dApps, apps that interact with the blockchain, such as the ones described above, and decentralized autonomous organizations, DAOs, corporations governed by the community. Blockchain. We've all heard this buzzword thrown around, but what exactly is it? In a nutshell, blockchain is a safe, decentralized database. More specifically, the blockchain is a distributed ledger shared across computer network nodes that saves information electronically and ensures data integrity without a central controller. But how can it be secure if there's no centralized control? That's an excellent question. The database is constantly copied on every computer on the network. So if one person out of 4 attempts to fake the data, there are 3 others who can check what is accurate and what is not. The blockchain, in further depth, is a growing collection of records, or blocks, that are connected together via encryption. When a block's storage capacity is reached, it's connected to the preceding block, producing a data chain. Because each block includes information about the preceding one, data that's been recorded cannot be changed retroactively without affecting all future blocks. As a result, blockchains are resistant to change. Blockchain was created in 1991 with the intention of developing a system in which record timestamps could never be changed. However, its first significant use was with Bitcoin, 2009, where it served as a digital ledger for recorded transactions. This is why blockchain is also referred to as distributed ledger technology. Cryptocurrencies. Cryptocurrencies are just monetary transactions recorded on a blockchain. Crypto, which functions as digital currency with ownership records saved and validated in the blockchain network, has 3 primary characteristics. 1. Trustless. Without depending on anybody, each network component confirms what the others say. 2. Immutable. Every payment is recorded, and altering this history should be very rare or impossible. 3. Decentralized. Without a single point of failure, crypto is virtually decentralized, and with no single point of structural breakdown. But how is a crypto token created if it's not issued by a government or a bank? Another excellent question. Cryptocurrencies are mined. Every time network actors, miners, verify block data, transactions, in accordance with certain predetermined rules, proof of work system, they're paid with a network token, i.e. Bitcoin, for auditing the blockchain, resulting in the creation of new units of currency. The larger the network, the more secure it is. One individual would need a supercomputer the size of the moon to deceive all the other miners and change the data contained in the blockchain. Satoshi Nakamoto mined the Genesis block, block number 0, which carried a reward of 50 BTC on January 3, 2009, and so the Bitcoin network was born. After that, he mined around 1 million coins before vanishing in 2010, leaving the project in the hands of Bitcoin believers around the world. If you wish to participate in the network, just download Bitcoin's open source code and begin mining. However, keep in mind that in order to verify a block, you must identify the nonce before others, which becomes more difficult as the network increases. Today, the size is about 350 gigabytes and 1 million miners. Mining is organized as a competition amongst miners who want to be the first on the network to verify a new block and pocket the prize. If you want to get into the crypto game without mining, you may just do what most others do, invest. But before we get into that, it's vital to grasp the distinction between a crypto wallet and an exchange. Crypto wallets, such as MetaMask and Exodus, are programs that keep the private key that enables you to access your cryptos. If you lose it, your Bitcoins are lost as well. Exchanges, like Binance, Kraken, and KuCoin, are where you can purchase and sell coins by linking your crypto wallet. However, some of them also offer a wallet service. Please keep in mind that since they gather personal information and are actively managed by an organization, all of these platforms are centralized. If you're ready to forego a little intuitive use in return for privacy, you can always go with a decentralized exchange, a DEX, such as Uniswap or PancakeSwap. Other cryptocurrencies, known as altcoins, began to develop based on the Bitcoin algorithm. There are over 10,000 alts available today, and you can discover them all on CoinMarketCap. If it's not there, it's likely fake. A new digital currency is frequently accompanied by a tech initiative using blockchain and decentralization of something. In reality, there are two categories of investors in the crypto realm, just as there are in the stock market, traders and holders. A trader solely considers short-term price fluctuations and buys and sells numerous times each day. A holder, on the other hand, engages in value investing by holding long-term positions in tokens tied to potentially valuable projects. The latter requires extensive investigation since new initiatives emerge on a daily basis, and you don't want to bet money on a token produced this morning by some teens for fun. DTube coin, for example, is a currency created for the aforementioned decentralized video network. It's currently worth 30 cents. Is it a worthwhile investment? Who knows? It depends on whether you believe people are ready to transfer from YouTube to DTube and how serious the project is, i.e., extent of the use case, team connections and website, and community activity. After Bitcoin, the most significant crypto is Ethereum, which was launched in 2013. Ethereum is at the forefront of this new Web3 revolution, bringing blockchain decentralization to many aspects of life, not just commerce. Nonetheless, the most brilliant notion those intrepid developers had was that even code can be decentralized, which is what smart contracts are, a set of rules encoded and permanently stored on the blockchain, using the Solidity programming language. As a consequence, we're presently experiencing a new phenomenon. dApps are open source apps built using smart contracts that communicate with the blockchain. For example, we can see how DTube's video recommendation system works by reading the whole code. Do you know how YouTube's works? Anyway, have fun exploring the most popular dApps. DAOs are centralized organizations that are built on smart contracts and do not need a CEO, since everything is governed by the community. Because everything is open source, each token represents a vote, and there are no corporation secrets. It's still uncertain if a business plan like this can be sustainable in the long term. The DAO, a venture capital fund created in 2017 that received $170 million but was hacked and lost in the first 6 months of operation, is a well-known painful example. Because any ownership contract may be recorded on a blockchain, we now have in hand the concept underpinning both NFTs and decentralized finance for the first time in history. NFTs. Non-fungible tokens, NFTs, are digital assets that are recorded on a blockchain. To put it another way, an NFT is a contract that grants ownership of a portion of the internet. A photograph of your dog is not an NFT, since it is not unique. It can be copied and pasted. Hence, it's not a digital asset that can be possessed. An image of your dog recorded on a blockchain, or minted, on the other hand, is an NFT, since it is unique and, hence, a digital asset that can be possessed. Any digital file, pictures, videos, music, video games, may become an NFT through a digital ledger that gives a public certificate of authenticity or evidence of ownership. Because of the blockchain's capacity to ensure the unique signature and ownership of the item, digital art was an early use case for NFTs. In 2014, a digital artist registered the first known NFT, Quantum, which was sold in an official Sotheby's auction in early 2021 for more than $1.3 million. Since then, NFTs have gradually gained public attention until erupting into widespread usage in early 2021. These NFTs are purchased for one of three reasons: enthusiasm for art, such as purchasing an original Picasso; status, such as a Rolex watch; or to resell at a greater price. How can I make NFTs? This is a natural question to have, especially when people are paying multiple Ethereum to secure the rarest and trendiest NFTs. The first place to go to mint an NFT is OpenSea, the world's biggest NFTs marketplace and one of the most popular dApps. Once you've created an NFT, you can showcase it in a virtual art gallery. Showing off digital assets in such a gallery is amazing in itself, but it can also kickstart a lucrative line that becomes the next Bored Apes or cyberpunks. Cyber and spatial are the most often utilized platforms for this. DeFi. DeFi, decentralized finance, is a new financial system built on blockchain that does not depend on middlemen like banks. It all started in summer 2020, also known as DeFi Summer, when crypto users began to be paid for placing money in the DEX Uniswap, a process known as liquidity mining. Because decentralized exchanges have less liquidity than centralized exchanges, some type of incentive was required. As a result, consumers realized they could make interest by depositing and lending cryptos without relying on banks, since smart contracts, pieces of open source code, were running and functioning as an intermediary. Everything I've argued about internet behemoths holding and profiting from your data can be applied to the banking sector as well. DeFi is the new alternative to centralized finance, which is discriminatory and costly in Web3. On the contrary, DeFi is available to anybody, even those in undeveloped nations who do not have access to the conventional financial system. Nobody knows who you are or where you come from on Web3. But how can lenders protect themselves from high-risk borrowers and frauds if it's anonymous? You're bursting at the seams with wonderful questions today. Banks use collateral in the same manner they do in the real world. For each blockchain, there's a marketplace for borrowers and lenders, such as AOV, and NFTs are often used as collateral for loans, like NFTFi. The NFT used as collateral is protected by a smart contract and recorded on the blockchain. This implies that if the borrower fails to repay the loan, the smart contract will immediately sell the NFT to raise funds to refund the lender. So, if you're the "I'll pay next week" sort of borrower who's often late, avoid DeFi, since there's no middleman to deal with because everything is automated. Furthermore, those who can't stomach taking chances with their money may employ decentralized insurances, such as Nexus Mutual, as the icing on the cake of this sort of organization if anything goes wrong, because certainly things may go wrong. For example, a smart contract with exploitable flaws. Metaverse. The Metaverse is a system of three-dimensional virtual worlds linked to the blockchain that will serve as the front end for this decentralized Web3, much like browsers served as the front end for Web2. To put it another way, you've previously interacted with people and businesses digitally via a flat screen, but now you can do so in 3D space. You can literally walk into the internet. The majority of people today associate the Metaverse with some sort of 3D RPG game, but it's much more than that. There are some virtual spaces with a game component, but the major transformation is taking place behind the scenes with the decentralization of authority. If an online video game is not decentralized, it's not part of the Metaverse. Second Life, established in 2003, was the first online platform that enabled individuals to create an avatar for themselves and interact with others in an online virtual environment. Despite being rather innovative for the time, It even used its own virtual currency. It's not really part of the Web3 metaverse since it does not utilize the blockchain. Everything you purchase on it, such as avatar clothing, belongs to the corporation that owns the platform, not to you. The same is true for popular online games like Fortnite, where anything you buy there is exclusive to that platform and cannot be used anywhere else. On the contrary, whatever you buy on the blockchain becomes your digital property in the metaverse. You can think of the metaverse like a massive retail mall that's attempting to emulate the characteristics of the actual world. For example, you're traveling through a VR metaverse when you see advertising for a cool digital belt and decide to enter and purchase that belt for your digital character. Because you own it, you'll be able to bring and utilize it in other metaverses as well as resell it. Having stated that, let's investigate how many metaverses exist and how we might get access to them. The majority of them are simply accessible through a browser, but many may need a decentralized crypto wallet like MetaMask to log in, and some may even require a virtual reality VR headset or suit. Each metaverse makes use of a blockchain and a distinct cryptocurrency to allow users to conduct transactions. At the present, the most popular are the Sandbox, which employs the crypto Sand, and Decentraland, which uses Mana. Keep an eye on the Metaverse Index, MVI, which combines a basket of tokens meant to represent the trend of the virtual environment. So, what are people up to in these metaverses? People are buying and selling NFTs, and the market is thriving. But the most talked about NFT right now is land. Yes, real people are purchasing virtual land. There is a restricted supply, which adds value and allows for the establishment of virtual real estate agents. An intriguing truth is that purchasing a parcel of property where a company already exists grants the right to share the profits. For example, if you are successful in purchasing a part in the casino established by Decentral Games, you'll become a member of the DAO and be entitled to vote on corporate decisions, as well as a percentage of the profits. Unrelated, but equally intriguing, they seem to be recruiting for that virtual casino. Many regions of the metaverse are currently vacant. People congregate during important events, but most of the time it seems to be deserted, with empty storefronts and vacant squares. But I suppose the web didn't have many visitors in the early 2000s. According to some observers, participating in the metaverse seems to be a wise decision since all of the major players from many sectors are joining the game and will want room to post their commercials. Domino's Pizza moved their advertising into Roblox by constructing a digital restaurant. Aruba is establishing a foreign embassy in Decentraland, and Travis Scott performed in front of 12 million people within Fortnite. Horizon Worlds is the ultimate word on Facebook's metaverse. It seems to be exclusively accessible with a VR headset, and it happens to be a lot of fun, with fantastic HD visuals and a lot of capabilities, games, fitness, work. However, since it is blatantly centralized, sticklers do not believe it to be part of Web 3. Web 1, 1983 to 2004, read-only static HTML pages. Web 2, tech behemoths possess your personal information, 2004 to now. Blockchain is a safe, decentralized database. Cryptocurrencies, blockchain transactions. Smart contracts, blockchain code. dApps are blockchain-based applications. DAOs are blockchain-based enterprises. NFTs are blockchain-based digital assets. DeFi is blockchain-based finance. Metaverse, blockchain-based 3D virtual worlds. Web 3, everything said above, plus who knows what else. With so much chatter about Bitcoin, it might be difficult to cut through the jargon to uncover the basic knowledge to get started by understanding Bitcoin's history. The fundamentals are simple and will give you a strong foundation in a matter of minutes. Bitcoin is still a nascent financial innovation, so its history isn't very extensive. The technology that underpins it dates back to 1998, when efforts were made to develop an entirely digital money. BitGold and B-Money were two prospective currencies that received some interest but never truly took off. It wasn't until 10 years later, in 2008, that the first rumors of Bitcoin were buzzing around online. Soon after, Bitcoin took off among enthusiasts and mining started. Satoshi Nakamoto and the beginning of a new currency. The suspected alias for the unknown Bitcoin developer is Satoshi Nakamoto. While considerable conjecture surrounds the identity of Bitcoin's developer, no one knows for certain who established the world's first and most widely used cryptocurrency. On August 18, 2008, Bitcoin.org was registered, and on October 31, 2008, Satoshi Nakamoto submitted a paper to a cryptography email group. The article, titled Bitcoin, a Peer-to-Peer Electronic Cash System, described a peer-to-peer system for electronic transactions that do not depend on trust. Satoshi Nakamoto mined the Genesis block of Bitcoin on January 3, 2009, thus beginning the network. The following text was included in the Coinbase of this block. The Times, January 3, 2009, Chancellor on brink of second bailout for banks. On February 11, 2009, the very first transaction on the blockchain was 10 Bitcoins delivered to Hal Finney, one of the early advocates, adopters, and contributors to Bitcoin. A protective measure against banking. The language buried in the Genesis block's Coinbase reveals Satoshi Nakamoto's motivation for creating a new currency. The text is a caption from a story in the London Times on January 3, 2009. The article discussed the British government's inability to revive the economy in the aftermath of the 2007 and 2008 financial crisis. Nakamoto's concern about too-big-to-fail banking organizations was a major motivator for Bitcoin's invention. Nakamoto envisioned Bitcoin as a method for people to have complete control over their funds without the need for a corporate intermediary. This is what it means to say Bitcoin is trustless. Parties transmitting money have traditionally depended on an intermediary, generally a bank, to arrange the transaction. Bitcoin and blockchain technology eliminate the requirement for both sending or receiving parties to trust each other in order to conduct a Bitcoin transaction. Bitcoin's protocols, or code, enable the system to function and reach consensus without the involvement of a third party. True peer-to-peer transactions may take place without the need to trust the entity with whom you are transacting. History of Bitcoin price. To say the least, the price of Bitcoin has been volatile. For the first several years, the cryptocurrency had minimal value since it was mostly utilized as a curiosity among a small group of early adopters. However, in 2011, Bitcoin investors started to experience the price fluctuations for which Bitcoin would become famous. BTC 2011. Bitcoin's price in early 2011 fluctuated significantly. The price skyrocketed from $1 to a peak of $32 in June, a 3,200% increase in 3 months. The price subsequently fell precipitously, dropping under $2 by November, but things began to improve for the digital currency as early as the following year, when it hit $4.70 on May 13th and $12 by August 12th. BTC 2013. The year 2013 ended up being a watershed moment for Bitcoin's price. The digital currency started trading at $12.40 and had 2 significant price increases. In early March 2013, the price hit $210, a gain of nearly 300%, before plummeting to trade around $70 by mid-April. What occurred next, though, was much more spectacular. From October to December, Bitcoin increased from $123.20 to over $140. BTC 2015. Bitcoin prices began at $320 in 2015 and dropped to $167 by mid-January. It leveled out through the summer, then another rise occurred on November 28th. This was attributed, in significant part, to a big exchange receiving $77 million in a Series C fundraising round. Bitcoin hit a high of $455 by December 16th. BTC 2016. In 2016, Bitcoin reached a low of $348 on January 26th and a high of $968 on December 28th. Hackers targeted Bitfinex, a prominent Bitcoin exchange, in one of the first significant attacks. The incident resulted in the theft of 119,756 BTC from them, which made the news all around the globe. In 2016, Bitcoin had its second halving event, with the reward reduced from 30 to 15.5 BTC. BTC 2017. Bitcoin users made enormous profits in 2017. Bitcoin's lowest point this year was $755 on January 9th, and its greatest point this year was $18,843 on December 18th. There were other milestones between these 2 days that increased BTC's popularity. In 2017, for example, more and more businesses started accepting Bitcoin as payment. A hard fork also occurred, causing a portion of the community to separate into what is now known as Bitcoin Cash. BTC 2018. In 2018, Bitcoin had a difficult year. On January 6th, the cryptocurrency achieved a high of $18,135 before continuing to fall and eventually reaching a low of $3,700. Google and Facebook have also indicated that they would restrict any cryptocurrency-related marketing. Bitcoin sank to $3,483 on February 22nd, but by mid-2019, it had soared back to over $10,000 USD. The excitement was short-lived and Bitcoin began to fall steadily as the halving date approached. BTC 2019. By May 2020, the market value of Bitcoin had reached $7,275, and a bullish pattern seemed to be emerging as Bitcoin approached its halving. However, following the halving event, the price fell by roughly 11%, eventually settling at around $10,000 USD. The COVID-19 pandemic had a significant influence on the overall economy in 2020. This led Bitcoin's price to drop, and it did in all markets. The cryptocurrency began the year at $7,300 and has since dropped to about $5,000. However, the anxiety in conventional markets drove up BTC prices, and by November 23rd, Bitcoin was selling for $18,353. BTC 2021. Bitcoin spent the bulk of 2021 soaring and setting new price records. BTC began at roughly $29,700 in February and has since risen to an all-time high of over $68,000 USD in November. This is despite the fact that the U.S. government has issued several legal threats and the digital asset has been prohibited by the Chinese government. Section 2. Bitcoin mining. The method of issuing new Bitcoins is comparable to that of collecting precious metals from the ground in several respects. As a result, it's been dubbed Bitcoin mining. The ongoing creation of new coins is akin to gold miners devoting energy to introduce gold to circulation. In our situation, CPU time and power are used. Summary of Bitcoin mining. People compete for Bitcoin rewards by putting their computational power to use in a process termed proof of work, POW. The method is called that because only participants or miners who have demonstrated adequate resources, labor, will be eligible for the rewards. Rewards are paid to a single winning miner every 10 minutes. The benefits are twofold. First, the block reward, which is a fresh Bitcoin. The current block reward is 6.25 Bitcoins, but will be halved in early March 2024. Second, the fees for all operations in the current block. and users who want to conduct a transaction must add a fee as an incentive for miners to put it in the next block. What is the purpose of Bitcoin mining? Bitcoin mining is a vital part of the network's method for reaching agreement on the present state of the database. It's critical for users to be able to conduct Bitcoin transactions in a safe manner. The Bitcoin network is a worldwide distributed public ledger that contains a huge list of publicly available transactions. Every 10 minutes, the ledger is changed by uploading blocks that include a series of new transactions. The presence of the record, which is freely maintained by thousands of people known as nodes, enables anybody to see both the present status and the whole timeline of Bitcoin ownership. There's no central authority choosing which transactions should be included to new blocks by design. Instead, the ledger state, i.e. the truth, is determined collaboratively and via collaboration by nodes in line with the Bitcoin network. This decentralization is responsible for some of Bitcoin's most intriguing qualities, such as censorship resistance and permission-free. Most nodes merely verify transactions, keep the ledger, and relay changes to other nodes. A smaller set of nodes, known as miners, compete to produce new blocks. Miners are essentially revising the status of the ledger or the information about who owns what as they produce new blocks. Bitcoin mining serves a number of purposes. 1. It's a way of issuing fresh coins. 2. It's a component of a larger system for guaranteeing that only genuine transactions are uploaded to the blockchain. 3. It offers a financial incentive for members, miners, to contribute assets to the system, and the energy dedicated contributes to the network's defense against attackers. It's worth noting that the term assailants here mostly refers to the miners themselves. This means that by making mining costly, Bitcoin guarantees that miners respect the rules. How does Bitcoin mining keep the network safe? Proof-of-work mining contributes to the security of the Bitcoin network by forcing prospective attackers to commit far more to an exploit than they could possibly earn from the assault itself. In other words, it assures that targeting Bitcoin is a highly expensive and unprofitable prospect, making it very unlikely. The following is a summary of the procedure from the Bitcoin white paper. 1. All nodes are notified about new transactions. 2. Every node adds new transactions to a block. 3. Each node is attempting to discover a tough proof of work for its block. 4. When a node discovers a proof of work block, it broadcasts it to all nodes. 5. Nodes will recognize the block only if all the operations in it are genuine and have not previously been spent. 6. Nodes communicate their approval of the block by constructing the new one in the chain with the hash of the accepted block serving as the previous hash. What effect does Bitcoin mining have on the Bitcoin price? In most situations, miners sell their Bitcoins to finance their mining expenditures. These expenses, in turn, add to the overall selling pressure. Miners' efforts to maximize profits by keeping or selling Bitcoin, depending on market momentum, may affect Bitcoin's price volatility. The reasoning here is that even when the price of Bitcoin rises, miners may try to hang on for a longer period of time in the hopes of extracting more profit. This might lead to a lesser net selling pressure, resulting in a quicker price increase. However, as the price of Bitcoin falls, miners are more inclined to sell, not just their stockpiles, but also freshly acquired Bitcoin, which in turn drives downside volatility. Section 3. Bitcoin or altcoins? Although Bitcoin continues to dominate the cryptocurrency market, there are many competing digital assets known as alternative cryptocurrencies or altcoins. With so many options available, investors must understand how each altcoin varies from Bitcoin and what it can offer in an investment. Altcoins may be thought of as Bitcoin variants. In other words, developers build altcoins to enhance the functioning of Bitcoin or to provide features that Bitcoin does not have. However, not all cryptocurrencies are the same. While some alternative currencies may have value for investors, others progress only on excitement and live on conjecture. Many altcoins have had spectacular climbs in 2021, mirroring Bitcoin's surge, which has risen more than 110% as of November 15th. Ethereum, ETH, Bitcoin's main rival, has risen roughly 500% year-to-date, while the upstart Shiba Inu coin, SHIB, has gained an incredible 380,000% in a year. Differences between Bitcoin and other cryptocurrencies. It is fair to claim that Bitcoin has superior investment fundamentals to the overwhelming majority of altcoins. Bitcoin is the most popular cryptocurrency, having been acquired, owned, and exchanged the most. It has a market valuation of around $1.2 trillion, accounting for more than 60% of the entire market capitalization of cryptocurrencies. Bitcoin's trade volume exceeds $30 billion, indicating that it is a very liquid asset. Unless a solid practical case can be made for each Bitcoin alternative, there's a great likelihood that the currencies will ultimately fade away. Many cryptocurrencies were established for experimentation, but even those with superior foundations will struggle to catch up to Bitcoin. While this is going on, Bitcoin's popularity is increasing. There is some disagreement over how to approach Bitcoin as an investment, but it is designed for future usage. Some investors view Bitcoin as a means of storing money, citing its growing acceptability as a payment currency. Furthermore, demand for Bitcoin is increasing among both individual and institutional investors. As a consequence, increased investor interest leads to higher legitimacy and acceptance of Bitcoin over time. Another element that contributes to Bitcoin's supremacy over altcoins is that Bitcoin has shown the capacity to endure market collapses. Investing in alternative cryptocurrencies. When Bitcoin rises, altcoins tend to rise as well, and when Bitcoin falls, altcoins tend to decline as well. However, the climbs and falls of altcoins are even more volatile than those of Bitcoin. Altcoin investors who wish to diversify their holdings should evaluate the dangers involved with these digital assets. There are over 10,000 cryptocurrencies, so the chances of selecting one of the handful that will be around for a long time are slim. If you select the appropriate altcoins, particularly the smaller ones, they have the potential to give exponential returns on your original investment. In late 2021, one Solana was worth over $200, but had only cost $2 a year ago. Most cryptocurrencies, on the other hand, will never take off and will likely lose what little value they have if the project is not maintained. That being said, let's look at all the altcoins that have outperformed Bitcoin's returns, beginning with the biggest altcoin in terms of market capitalization, Ethereum. Ethereum's success is largely due to the fact that it serves as the foundation for several other famous cryptocurrencies. Ethereum debuted in 2021 with a cost of almost $730. By mid-May, it had risen to about $4,300. This was no small effort, an almost 500% return in less than 5 months. Ether is now selling at $3,600. At the time of writing, the year-to-date return is approximately 400%. However, there are a few other cryptocurrencies that have outperformed Bitcoin's year-to-date return by an even wider margin. One of 2021's best examples was Axie Infinity, AXS. A blockchain is used by Bitcoin to create digital cash, while Axie Infinity utilizes it to create a game. It created the governance token AXS in order to offer people control in the game. AXS, during the height of the 2021 bull run, was trading at $122. It cost 54 cents at the start of the year. This is an almost 22,500% year-to-date return. Many other cryptocurrencies, such as Phantom, Telcoin, and Dogecoin, had more than 1,000% year-to-date gains at the time of writing. It's true that Bitcoin is the king and market leader, but there are undoubtedly much bigger returns on investment for those who can separate the wheat from the chaff of 10,000 plus altcoins. Section 4. Bitcoin as an alternative to banks. In 2009, Bitcoin's inventor, Satoshi Nakamoto, described it as a purely peer-to-peer form of electronic payment. Jamie Dimon, CEO of JP Morgan, termed it a sham. Twitter creator Jack Dorsey believes it has the potential to become the Internet's single currency. Bitcoin has many different faces to many people. This multifaceted perspective belies a more fundamental question. What is money? What's a medium of exchange? What is a store of value? Is money a formal expression of deferred gratification? In the proper conditions, all of these may be true. As Bitcoin grows in popularity and use, defining and controlling what Bitcoin is will be a battle waged by both supporters and detractors of the technology. The stakes are great, and narratives will shape Bitcoin dynamically. The conventional debate circles around whether Bitcoin is money or an asset, yet here's a somewhat different light than the typical labels. Bitcoin represents a financial system alternative. The phrase alternative financial system goes to the heart of Bitcoin's vision and value, which is to provide an alternative to established financial systems. In the first sentence of his paper proposing Bitcoin, Satoshi plainly states the problem. To handle electronic payments, Internet commerce has evolved to depend nearly entirely on financial institutions acting as trusted third parties. When you concentrate on this feature of Bitcoin, the ability to have another alternative, you'll have a better understanding of how Bitcoin fits into the wider picture. You only have the illusion of choice if you don't have Bitcoin. Euros or US dollars, Goldman Sachs or JP Morgan, TransferWise or PayPal. When you trace all of these options back to their origins, you see they all lead to the same place: government-issued money and conventional banking institutions. Bitcoin actually provides you with another alternative. It is fundamentally a distinct alternative to the current financial world with its own set of rewards and downsides. That begs the issue of how Bitcoin is radically different and where it is most beneficial. More than 10 years after its inception, the utility of Bitcoin is still being debated. It is and will be applied in a variety of ways, but we've always understood what distinguishes Bitcoin from other systems, and we'll look at two of them today. Bitcoin is not a government-issued currency. Governments print the majority of money. United States dollars are created and backed by the full faith and credit of the United States government. Money's worth and trust are inextricably linked to faith in its issuing authority. If you own government-backed money, you're subject to the policies and choices of that government, whether they're good or harmful. Historically, such monetary policies have varied and aren't always in the economic interests of the public who possess the currencies. One of the most fundamental characteristics of Bitcoin is that it is neither issued nor managed by a government. Bitcoin, on the other hand, uses open source code to establish an automatic, transparent monetary policy. There are advantages and disadvantages to the strategy, but one undisputed benefit is that the quantity of Bitcoins on the blockchain is known and predictable. Unlike many inflationary currencies, Bitcoin is disinflationary, decreases inflation over time, and will ultimately reach 21 million total Bitcoins under current protocol regulations. People in high inflation nations, or those who are otherwise disinterested in the value degradation caused by inflation, may find this disinflation appealing. The advantages and disadvantages of Bitcoin's monetary policies, such as its constant total supply, are hotly contested, but one thing is certain: it's not like any other choice, even government-issued currency. This allows people to opt out from the current system or to have another choice alongside it. Bitcoin has its own network for settlement. How can you send $1 to someone in the United States? Transfer through bank wire, cash through the mail, Apple Pay? Many have used one or more of them at some time in our lives. You must use the standard banking system to conduct transactions unless you cash out your assets into tangible dollars and deliver them straight to someone. Sending money within the United States and much of Europe works rather effectively, but it isn't always ideal in other places with poor bank technology or strict capital regulations. Due to increased transaction costs and delayed clearing periods, international payments are a regular source of frustration for almost everyone throughout the world. This is due to a broad and disjointed network of underlying conventional systems, which might vary significantly per nation. When you add in local rules and regulations, you have an extremely sophisticated global financial system. Bitcoin is a peer-to-peer network that runs on the internet. It's maintained by users using Bitcoin software all across the world who are rewarded by the network itself rather than a national bank or government. You can simply transfer Bitcoin anywhere if you have a cryptocurrency address and an internet connection. In fact, you don't even need the internet. This is very beneficial since the Bitcoin network is entirely independent of the current financial infrastructure. In certain circumstances, this allows Bitcoin to be cheaper or quicker than conventional options. In other instances, Bitcoin may not be cheaper or quicker, but it's still beneficial as a different financing network, such as when individuals are concerned that their money may be taken or devalued in existing systems. An alternative, though not always a substitute. Because Bitcoin is an alternative, it doesn't have to entirely replace established systems. This is a prevalent misperception shared by Bitcoin supporters as well as conventional financial experts. Bitcoin will be ideal in certain circumstances, while the traditional system will be best in others. You may think that the US dollar is a powerful form of value, that your financial institution runs well, and that Bitcoin has enormous potential all at the same time. Over time, the hope is that more participants on both sides learn to accept the prospect of cohabitation. It may become clear when tools and technology advance for both Bitcoin and banking. The ideal situation is one in which the qualities of both systems are available and used by individuals all over the world to select how they interact and exchange value on a global scale. This has been The Ultimate Guide to Investing in Cryptocurrency: How to Make Money on Blockchain, DeFi, Bitcoin, Altcoins, NFTs, and the next big thing, the Metaverse. Written by Christie Brothers, narrated by Russell Newton. Copyright 2022 by Christie Brothers. Production copyright by Christie Brothers.